Hello and welcome to episode 55 of the Portfolio Matters weekly update. As usual, there's lots to talk about this week, but first, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Thank you, Stuart. And I should just point out that Keith is away on holiday this week. So, news. Well, clearly it's been a very volatile week from the point of view of share prices, and we'll come on to that. We have the ECB warning European banks to be ready for sanctions against Russia. Clearly, if the situation regarding the Ukraine were to deteriorate and financial sanctions were to be put in place, more severe sanctions were to be put in place, then the European banks have some significant exposures that they would need to address. And then the Federal Reserve is signalling its intention to raise rates in March 2022. The first rate increase for 4 years. So quite a week. This is just three charts of the top left, the Nasdaq, top right, the US 500, and in the center at the bottom, the FTSE 100. And the market was very volatile. But if you look at where the prices currently are in the scheme of things, they haven't really corrected by very much. And all of these graphs were prepared at lunchtime today. And as we know, things are very volatile at the moment. So by the time you see this, the graphs may actually look different. Stuart, do you have any comments on these?
Well, I think it's one of those times where, as a private investor, you've got to be taking a longer term perspective, haven't you? There's no point trying to second guess this sort of behavior, this sort of volatility. It's time to switch off the screens and think about what you want to be doing strategically.
Yeah, I completely agree. So moving on to this week's economic data, we'll just pick a couple of interesting items. So I'm going to go for the easy low-hanging fruit here, which is the UK public sector net borrowing came in at much better, significantly better than expected. And that is, I think, a result of the economy picking up and tax increases increasing. But I did also notice that the cost of servicing UK government debt has gone up significantly as a consequence of the increase in the interest rate on the inflation-linked bonds.
Well, that is interesting because I've always thought of UK debt as being very low cost, but that's one segment and they can't get away from it. What is it? About 20% of UK debt is linkers.
I'm not sure, Stuart, but it was a significant chunk of money that it had gone up by. So that sort of figure makes sense. And of course, the interest, the rate of inflation has increased significantly and quite quickly. So I guess an unprojected, from the point of view of the Treasury, unprojected additional government expenditure.
So presumably the inflation, if it does feed through into wages, will actually give the government a bit of a windfall because tax thresholds have remained flat in nominal terms.
Yeah, payroll taxes will pick up. So the second one we've got here is the Case-Shiller House Price Index, the US House Price Index, which Stuart has. I know you're going to talk a little bit about that later, aren't you?
Yes, a little bit. I mean, I just find the numbers extraordinary for such a diverse housing market that the overall index can be up, over 18%. I find that just sort of flabbergasting, and what that must be doing for inequality in the States.
Yeah, and I guess probably the last interesting thing I'd like to pick out would be the EU consumer confidence. Now, it was a miss, but the consensus expectation wasn't great. Presumably this is the effect of Omicron, but I don't think that's particularly good for the European economy. So the economic update charts We have UK retail sales month-on-month change, EU consumer confidence. All the PMIs, most of the PMIs are heading downwards, I've noticed, and have been for the last few months.
Yeah, it's not too dramatic, is it? You can well imagine COVID, causing that sort of slight depression. I mean, these are nothing like we've seen in previous cycles, or indeed, obviously during the initial pandemic.
Yeah, indeed, and also they're sort of heading down to the levels that they were at pre-pandemic.
Mm.
So this is a graph of UK public sector net borrowing, which whilst it's...
Yes, I'm sort of interested in this one because I think Boris Johnson's cakeism is infecting the rest of the Conservative Party, that whenever there's an attempt to balance the books, to do anything that you would think of as traditionally Tory, there's howls of protest. And I think, who was it? Jacob Rees-Mogg was talking about, no, we have to subsidise energy prices and we have to abandon the national insurance increase. And we'll fund this from other savings elsewhere, undefined.
Yeah.
So that this complete desire to sort of to have it both ways and to avoid making hard decisions, I think, is unfortunately a sign of the times.
It is, and it's not realistic, is it? It leads to, in the end, it leads to grief and tears. There's US composite PMI also heading down back towards 50, and the manufacturing and services PMIs. And on to inflation watch. So the inflation figures across the board are, I would say, concerning. We are having a steady march upwards in all inflation numbers that we're getting, apart from Japan. And despite the best endeavours of the economists and the central bankers to tell us that inflation is peaking.
Well, Richard, you must remember that always and everywhere inflation is a transitory phenomenon.
Yes, Stuart. The ECB balance sheet is continuing to climb. Now 8.6 trillion. Is that about a third of GDP? Oh,
goodness. That's phenomenal, isn't it? Is it only a third? Huh? Goodness.
There might be more. I'm not, but it's a huge amount of money and a very steep rise. And we have this issue of the rising price of oil is starting to feed into, have an inflationary impact across the board, I would say. I think that the peak, a peak in a particular input price slowly spreads out and starts to affect the costs in all sorts of sectors, and it's a gradual process.
It's interesting to see, because I would have thought the economy had become much less sort of manufacturing, much less energy based, certainly compared to the 70s, and yet that correlation does look very strong.
It does, doesn't it? And what that's also suggesting is that CPI, if the correlation stands, the CPI is heading up towards 7% in the US.
Mm-hmm.
And the danger, of course, is that we, as we've discussed previously, we move into a wage price spiral. And this is just a little bit of anecdotal evidence of wages having to be bid up in order to recruit staff. So a couple of posters that someone spotted in Richmond High Street. Chef positions, all levels, £1,000 sign-on bonus.
Yeah, I was thinking of applying for the job and only doing it for a week until they sacked me when they saw my skill, but keep the grand.
Good point, Stuart. We'll all be down there.
I'm more likely to get the other job, I think, for cleaning the aircraft.
So, and this is from the FT the other day, economists expect inflation to peak in the spring. And I forgive me for being cynical, and we showed the graph last week, didn't we, where which shows economists' projections as through the course of an recent inflationary period. And basically, they have a line that goes down at 45, at 90 degrees to the 90-degree angle to the previous, the actual line. And it's like they have a spreadsheet that calculates what the numbers should be to create that 90% line. I don't believe it. I don't know where they get their numbers from, and I don't know how they have the nerve to continue publishing this nonsense when to date it's been proven to be absolutely wrong.
Yeah, nothing to add, Richard. It's dismal science, isn't it?
It is. And input prices growing at 15% there. And that just bodes for an unhappy few months to come at least. And in the same vein, we're going to do a little bit of a special on the fertilizer market. Now, thanks go to Keith for putting these together. As we all know, fertilizer is a hugely important ingredient in our agriculture, and without fertilizer, crop yields would be dramatically lower than they are. The first chart we have is urea. So nitrogen fertilizer demand is forecast to grow in 2022, and this is despite the very significant increase in prices that we're seeing. And there's a chart later that shows that. And the increase is primarily in India and the rest of the world. And the fact that demand is forecast to increase despite price increases indicates the dependence of the world on fertilizer for food production.
Now, Richard, that's an interesting chart. It's one of the few charts you see where the US and Europe and Japan are basically immaterial. That if this is reflective of where agricultural products are grown, then it's more reflective of a very different balance across the world. You know, China, India, and then the rest of the world is huge. Unless, of course, urea is not the main fertilizer used in the West. I have no knowledge.
No, possibly so. And then we have the apparent demand for combined demand for diammonium phosphate, monoammonium phosphate, and trisodium phosphate fertilizers. And again, we're seeing an increase in demand projected for 2022 as food production presumably goes up. And then the last one in this vein is the muriate of potassium fertilizer demand forecast to recover slightly in 2021. So what these three charts are showing us is that global demand for fertilizer is growing. And that is despite the 116% increase in fertilizer potash prices in 2021. So I don't know what the percentage of input costs fertilizer is for agricultural produce, and presumably it varies from plants to plant. But this is a massive increase in agricultural production input prices.
It reminds me, Richard, of that chart that I produced a couple of weeks ago from, I think, the OECD, looking at the real levelling off in the catch-up of emerging market income compared to Western incomes. And you know, if food is a much higher percent of emerging market consumption and you're faced with these sort of input price increases, then that's going to really continue the squeeze.
Yeah, it is, isn't it? And as we have discussed previously, the Arab Spring was partially caused by increased unrest due to rapidly increasing food prices. And here you can see the cost of nitrogen per pound. The nitrogen fertilizer, one of the primary sources of nitrogen fertilizer is natural gas. As you know, natural gas, methane, price of methane has gone up very substantially. And so we have 130% 50 to 200% increase in fertilizer prices in the last 12 months or so. And price of nitrogen fertilizer has almost trebled in, I think this must be a typo, should be 2021. And European fertilizers have gone up, prices have gone up fivefold, presumably because European fertilizer is made in Europe and European gas prices have gone up so much. So there's a massive inflationary impulse in food prices coming through with this year's, in the West, this year's seasonal production, I would suggest. And farmers have a choice. If they don't wish to use the fertilizer, their crop yields are lower and they make less profit. Or if they do use fertilizer, their costs are lower and they make less. Costs are higher. And they make
let's ask Clarkson, see what he's going to do.
Yes, presumably there's an intersection of those two curves, and the clever farmer tries to fertilize at the rate which maximizes his profit. But there is going to be a significant inflationary impulse in food prices, I suspect, as a result of this. And this is a graph of real and nominal food price index. And you can see that the the real food price inflation has risen very significantly in the last 12 months and is pointing almost directly upwards.
Yes, I think Jack Monroe has been making a real point of how these indices don't reflect the experience of everyone, and including the most vulnerable, where the loss of deeply discounted food is particularly hurting people who can least afford to make up the difference.
And rightly so, I think, because I was shocked to read this morning, in fact, that the ONS had taken off the detailed inflationary data from their website, and she was protesting that it needed to be there, otherwise people couldn't actually analyse what was really going on. And I do think that the behaviour of that sort of behaviour, where effectively it would appear to be a strategy to deny people information to understand what's going on in the real world, I do think it's totally inappropriate. And I'm very glad that she's making a stand, and that she has my 100% backing.
And just on a point of process and detail, I think the ONS have been talking about vastly increasing the set of prices that they monitor, because you would think it would be possible via the internet to screen almost every price and see how supermarkets are changing them, in real time.
Yeah.
Now, wasn't there a project called was it the $1 billion or Billion Prices project or something in the States to try to monitor at a very micro level all these changes?
And what people are really experiencing. And then you can put together multiple different baskets depending on socioeconomic status, geographic location, and start to get some proper information rather than this sort of manipulation of indices that we currently have, in my opinion.
Yeah. Right. Turning to all the hullabaloo in markets and trying to take a step back, I saw some very interesting research from Crestmont, and the top chart here looks at rolling 10-year returns in the stock market. This is all US data, and you can see that rolling 10-year returns have been about 15% a year, very much the top of the range. Now, if you want to be optimistic, you can say, well, rolling 10-year returns never seem to go negative, or only a couple of times. But really interesting thing to me was the decomposition Crestmont did, which is shown in the bottom chart, where they try to decompose returns into valuation expansion, earnings growth, dividend yield. Now, the really amazing thing, despite all the tech boom, is that the blue bars, the earnings growth contribution to market returns, is really nothing special. It's all been about valuation increase, which presumably is a lower quality source of return, more likely to mean revert. I was very surprised by that lack of earnings growth. I mean, possibly you could argue that more of it was real rather than inflation earnings over the past 10 years. But when I have a look at that chart in some more detail, it doesn't look quite as encouraging as you would expect.
And it's indicative of this earnings expansion as a result of lower interest rates, I presume, Stuart.
Yeah, well, the valuation applied to those earnings, yeah. And another way of cutting the cake is this scatter plot here, looking on the y-axis at, I think this is a smooth PE, like a Cape PE, and on the x-axis, subsequent returns to the market. And at the moment, we're up in those extreme valuation levels of over 35 times smooth earnings, which would indicate if the historic pattern, which isn't totally close, but would indicate modest returns of perhaps 6 or 7%. Frankly, I think 6 or 7% would be a very good return, given the valuation levels from which we're starting.
Yeah, indeed.
More things to worry about here. Speculative debt levels, a couple of measures of those. The first is margin at brokers. You can see it's not a very frequently updated number, unfortunately, but that's spiked up over the past year quite extensively. And also a new data series I was less aware of, which is prime brokerage gross volumes. And you can see that expanded a lot over the past couple of years as well. So both those measures suggest there's a high degree of debt backing the speculation in equities.
And as we know, the margin sellers are the first ones to exit when life gets tough because they have margin calls. And it can become an accelerating process, can't it, Stuart?
Yeah, I mean, perhaps it's something to do with these weird patterns, perhaps as a cause of the weird patterns we're seeing in markets, which seem to sort of flip-flop. Whatever is true at midday is not true at the end of day. Perhaps there's an awful lot of position hedging. Yeah. But I think, as we said then, that there's just so little a private investor can do or should do in that sort of circumstance. And taking a bigger perspective, these charts, I think, are a bit more useful to help make strategic decisions. The chart on the left here is the ratio of US market cap to US GDP, which you can see is a record all-time high. I think this is known as the Warren Buffett indicator. I've always been slightly skeptical of it on the basis of, presumably a lot of US companies have profits, earnings that need to be valued in the US market, but which are derived from outside the US. But equally, when you see something at such an extreme, you've got to ask yourself how speculative the equity prices are. The chart on the right has been the bane of my life because this is US corporate profits, US corporate profit margins. Now, this was a fantastically mean reverting series and told me to be out of the US market just until it stopped being mean reverting and pushed on to new highs and was one of the causes of the US equity market rising so strongly. But again, I might be talking my own book and relitigating old decisions, but my goodness, it's difficult to think that can go much higher. It
is. And of course, if it mean reverts fully back down to 5 or so, then it's going to be a very unpleasant experience, isn't it?
Absolutely, yeah. Right, now here's a couple of other charts that suggest the valuation extremes are not just in the usual suspects of the mega cap tech stocks. The top chart here, a rather busy chart, unfortunately, is looking at the price to sales ratio, the spread of that across the market. And what I take from this is to look at the bottom line. So those companies with the lowest price to sales ratios are still on very high price to sales ratios, which implies that across the whole market, everything is very richly priced. So even the best value is poor value. The chart at the bottom looks to do a similar thing, but by cutting the cake by capitalization, looking at large, mid, and small cap. And again, it just looks like there's a very high valuation being placed on any equity. It's looking to me vulnerable across the board. This is all stuff from Cushman research.
So we're not just talking about the tech, the non-profit making tech high flyers. We're talking about a lot of the mainstream businesses that are valued on high price to sales ratios.
Yeah, and the very fact that we've got to talk price to sales and not price to earnings because a lot of the companies haven't got earnings, that tells you something.
It does. So I always use a rule of thumb. It's a very simple rule of thumb, but if you want a price earnings ratio of 10, which in my youth used to be quite reasonable, and you've got a profit margin of 10, you're on a price sales ratio of 1.
Yeah.
And if you're on a price sales ratio of 10, either you're extraordinarily profitable, or you have an extraordinary high growth rate, which is going to lead to a significant level of profitability and a decent profit margin. I think a lot of this, we have high price sales ratios without the profitability or without the hope of sufficient level of profitability.
Richard, I think that there's an absolutely sort of world famous stock that fits the bill there, isn't there? I mean, Netflix. I mean, it's halved over the past the year to date, but it's exactly that situation, isn't it? It's highly valued on the basis of future profitability. Oh, but hold on, everyone else wants to launch a streaming service and costs go through the roof and profitability is never reached.
And they all want to launch streaming services, presumably, because the margins are so high. No, wait.
Well, they've got they've got to. Yeah, it's the only way to stay alive. So probably the best thing to do is sell out. Oh, that's the plot of Succession, isn't it? Yeah. Spoiler alert. Okay, now I'm normally gloomy and doom-laden, so I tried to put in a couple of charts to put the bull case. The chart on the left surprised me. Free cash flow margins before and after China joined the World Trade Organization. So here the argument is that you've opened up a pool of labour and a market, of course, and that has led to much better profitability for companies. Of course, the problem is that may revert. And the chart on the right, I still find surprising, but this is a flow of funds chart looking at where money has been put, and surprisingly, it's going into global bonds and not particularly into equities. So on that basis, you could say that that equities have not been pushed up by a wall of money, but that's what the data says, despite the fact that I would have assumed it would have been the other way around.
I wonder how they calculate those numbers on the right, Stuart.
Yeah.
Also, with the left-hand graph, it also roughly coincides with the start of central bank largesse and money printing, doesn't it? Oh,
good point. Yeah. Is this slightly earlier, perhaps?
Yes.
Yeah. Returning to a favourite subject, dividends. I'm quite an income investor. I do like that security and reliability. Obviously, dividends are not guaranteed and were cut during the pandemic, but dividends are, as a time series, much less volatile than earnings, and we've seen the dividend cuts that were instituted largely be unwound. So dividends are back up. Good news for income investors like myself.
Good.
That was a fairly short-term thing. Here's some longer-term data that I maintain for myself. There's a chart on the left for the States, chart on the right for Japan. The pinky purple line is the earnings index that you get by dividing the index level by the PE. And the blue line is the dividend index, which you get by multiplying the price index by the dividend yield. And my point is really to say that the dividends are much less volatile than the earnings. So if you are an investor who wants to harvest something from your portfolio, it's reasonably safe, I would say, to harvest the dividend income and hope that the capital floats up with GDP or something like that over the long term. The chart on the right, I think, is interesting to suggest that perhaps things are changing in Japan. Now that's an area where corporate balance sheets are in really quite good shape, and you appear to be seeing an emergence of pretty steady dividend growth. So, when I came to the markets, Japan was famous for being about 0.5% dividend yield. Now you might reasonably hope to get 2, which not too bad. And if it's growing as it has been over the past decade, some hope of dividend growth and diversity of bet there.
I particularly like the graph on the left-hand side, Stuart, because what it really says is, if you're a long-term investor and you invest in decent yielding companies, then it works.
Yeah, and this is just at an index level, so you do get some exposure to growth stocks as well.
Yeah.
Now, here's something of interest that caught my attention. We tend, I think, sometimes to think other countries have got stuff sorted and it's only us who've got problems. But these are a couple of charts looking at China's internal tensions. The chart on the map on the left is a map of Chinese provinces, color-coded to indicate the degree of income dispersion that there is in China, basically making the point that Beijing and the coastal areas are rich, most of the other areas are poor. And if you believe that Xi Jinping, in a sense, is the true communist and does want to ensure common prosperity, and it doesn't want a social revolution that overthrows the party, then this is the problem that he's facing. And the reason he's facing it now is illustrated, I think, in the chart on the right. This was an article in the FT talking about growing wealth inequalities in the world. But if you look at the green line, which is the US, it hasn't moved that much. What's really happened is within China, with a vast increase in income inequalities. And that, of course, is the risk that Xi Jinping wants to head off.
Which may in part explain why he's cracking down apparently on these very large privately owned businesses.
Yep. Here's a chart of the VIX. Unsurprisingly, given what's happened over the past week, it's jumped up. It's over 30 at the moment, which historically has been a good time to sell it, except in the few occasions when it wasn't, and you would have been blown up by selling it. But the point is that the VIX is very high. I thought Robert Armstrong in the FT had a good point that there doesn't so far seem to have been any of these sort of blow-up stories that you've sometimes seen in the past when frailties within the market have been hidden by a rising market. The fact that we've had volatility and to the downside, but not resulted in any big screw-ups is reasonably reassuring.
Yeah, and I think we will need to wait a little longer to see how things resolve, won't we, before we can say that nothing unpleasant is coming out of the woodwork at the moment.
True, yeah. US house prices, this one caught my attention because of the rate of increase. You can see there's a slight line at the right, which is where GDP fell. The Fed colors the charts in when there's a recession. But just look at the rate of increase in I think this is the Case-Shiller house price index, going up at over 18% over the past year. And I think, again, this is an impact from the Fed and low rates driving housing speculation. Richard, I know you've mentioned in previous shows about financialization of the economy, and I think housing is one very direct way that we see this. Yeah. Bloomberg had a fun podcast, and they were covering the difficulties one of the presenters had in buying a house because they were being gazumped all the time by people thinking that, rates this low, I can afford to pay another $10,000, $25,000, etc. But that podcast did make the interesting point that mostly the loans being made at the moment are long-term fixed rate standard US mortgages. they're not the sort of liar loans that we had in the previous housing crisis. So that may lock people into the loans they've got and the houses they've got, but doesn't seem likely to cause a quick unwinding of the bubble.
Yeah, makes you wonder slightly who it is who's on the other side of the fixed rate loans, given that either we have significant inflation and rates go up, and therefore fixed rate loans become incredibly expensive to have written, or rates don't go up and house prices continue to soar. Neither of which is a good outcome. So strikes me that more and more of these extremes we're seeing can't be resolved in a way that is satisfactory in any way.
But the US has got a different system, haven't they, with Freddie Mae and Freddie Mac and government underwriting of mortgages. So it'll all be on the government balance sheet.
It'll be on the taxpayer. Oh, that's okay then, isn't it? So this is a graph of container shipping rates, which shows that the shipping rates peaked in sort of the autumn of 2021, fell back a bit, but now they've started to rise again. And we know that there's all sorts of supply chain problems consequent on Chinese trying to follow a zero COVID policy for reasons best known to themselves. And presumably container ships getting caught up in all of that again. And I'm guessing that might be the problem. I don't particularly know. But what it means is that there's no deflationary impact of a reversion to the mean of these prices in sight yet.
Yeah, looks painful.
So a little graph of depiction of US consumer finances, which shows that they have total assets of 162 trillion and total liabilities of 18 trillion, and most of which is mortgages. And the household debt service ratio is only 9%. So that suggests that US households have a lot more borrowing capacity should they wish to exert it. And then the net worth graph at bottom right is sort of the same as the asset, effectively the same as the assets less liabilities in the chart on the left, which shows that we've got this sort of big exponential. I mean, it looks to me like an exponential curve from about 1990 onwards, increasing household net worth. So the proximal conclusion, I guess, is US consumers have very strong finances, and we may see a consumer spending boom. But we may also see that there's more of an inflationary push because people wish to spend their money more. And we may also, at some point, see that exponential increase ceases, as all exponential increases have to. What do you think, Stuart?
Well, I'm flabbergasted, really, by the magnitudes of the assets and liabilities. I could see net worth being high, but from the difference between two very large numbers. What surprises me is the modest size of liabilities compared to assets. It's not the difference between two large numbers, it's the difference between one large number and one small number. It's I had no idea that it was this, in a sense, robust. The other thing which occurs to me is that what happens with aging and the costs of, is that a liability which is difficult to calculate and therefore not in the liabilities stack chart there? If you think of all the ongoing sort of health costs and issues with aging, that given the lack of a US safety net, perhaps there's some liability there which could be added to that bar chart. Yeah.
But what this leads on to is that US consumers have plenty of borrowing capacity, and they appear to be using it. So moving on to the weekly checklists, the pretty volatile week for these markets, the equity markets, pretty volatile indeed. And I think that, as I said, these numbers were taken off at around about midday on Thursday. So they may well be significantly different by now. But if you were watching what was happening on a daily or an hourly basis to your portfolio, you would have had some leaps and some plunges. And I think, as Stuart rightly points out, unless you're a trader, you need to take a step back at times like this. I wanted to put in an Ark Innovation Fund. So I am strongly convinced that the technological aspect of the economies, Western economies, is hugely important, will be a hugely important place to invest in the future. And could and will be at the forefront of economic growth, no matter what happens in the short term with monetary policy and so forth. And the question is, when is a good time to invest in this sector? Now, I've taken the Ark Innovation Fund as an example. It's dropped by something like 60% from its high at the beginning of 2021. And, it's not showing any signs of turning up. Its moving averages and so forth aren't turning up. Stuart, what's your view on this? You're a very good long-term investor.
I wish. I think that there's absolutely no rush. There's the valuation ratios, the price to sales, etc., are still so extremely high. I don't think that you should be trying to catch this knife. I totally agree. Technology is changing the way business is done, improving efficiency. I would rather get a bet on that via a UK venture capital trust with a 30% income tax break, and just keep my eye on what's happening to something like Ark, because I think you're going to go through a period of revulsion where people are not going to want to touch this sort of thing. But quietly in the background, the winners will become evident. They'll start making money. You'll start being able to sort the wheat from the chaff. And it's at that point that you should be looking. But don't be panicked by the fact that you missed out on the rise, lurching to get in. I think these things can go very much lower.
Monday's price rally from deep intraday lows generally only occurs during bear markets. This is not a bullish signal. So this idea that on Monday we had something like a 4.9% drop in the Nasdaq, and then it moved up 5.8% for a 0.6% full day change, if those numbers exactly work out. So, but what this analysis is suggesting is that these extreme moves of this nature indicate that you are in a bear market, and the fact that it bounced isn't a signal of strength. And then this one shows that in midterm election years, which we're now in 2022, the intra-year, there is a significant intra-year decline in the S&P 500. And there's a significant return in years that aren't midterm in the following years. So that would suggest that this being a midterm year, 2022, you want to be very careful about expecting significant returns.
Yeah, I'd heard quite often about the year 3 return, those sort of pinky purple bars, but I was less conscious about the midterm bad year. But you can see the logic. Take the hit, the bad news in the second year, and then you can imagine the Fed being subject to various degrees of political pressure, trying to support the economy in year 3.
Interesting. So this graph shows that liquidity disappears just when it is most needed, exacerbating market falls. Stuart, what's your take? This
is fascinating, isn't it? This is fascinating. The way that markets have changed since I came into them is quite dramatic. It used to be a market maker making a price with a spread in a certain volume, and now it's all high frequency trading with algorithms that will do you a good service and give you a very tight spread when there's no risk, but which will run away the instant there's volatility out there, leading to big price gapping downwards. this is, I think, fascinating. When you look at companies like Citadel and Virtue and how they make their money, the algorithms, I have no special insight, but it seems to me that they protect obviously the P&L of those companies, and they're going to widen spreads. They're going to reduce acceptable trading volumes, and there's going to be no one to shout at. It's not like a market maker on a stock market floor who you can go and speak to and shout at to get a price. It's all going to be off there in the cloud, and you can't do anything about it. I remember Keith saying that he wanted to be trading in, I think, some US government bond ETF during the initial stages of the panic. I mean, this should be the most liquid security out there, and he found it was very difficult to get a price. It's extraordinary. I think it's one of those things where the new trading mechanisms help you 90% of the time, but then not when you need it.
Yeah, and you really need to have that in the back of your mind when you're looking at your positions and your vulnerabilities.
Yeah,
this is an interesting chart. It shows the that compared to earnings forecasts and sales, the Nasdaq Index is still high, yeah, this is. I mean, what I personally would say about this chart is that it follows a period where the Nasdaq has performed extraordinarily well, and so if you have a regime change, even this apparent correlation will fall apart.
Well, I think that this is the reason to think that the Ark ETF is something you should be still avoiding. I mean, look at the white line there, the forecast PE. Yes, they're growing companies. Yes, you'll pay more than you will for other companies, but to get back to the levels of valuation of a few years ago, there's still at least another 30% fall out there.
Yeah. And the average Nasdaq stock is now down to February 2021 levels, which is what ARK is actually. So ARK is a good reflection of the Nasdaq. And this shows the S&P 500 index median total debt to total assets, and it shows that the average S&P 500 company is relatively highly indebted in comparison to how it has been in the past.
Now that's interesting, because I've seen charts talking about debt as a percentage of total enterprise value, and that looks very unstretched. But of course, if the enterprise value includes the equity value, which is pumped up, then yes, the debt will look low. So a more traditional accounting measure like assets is arguably less relevant these days. But still, when you see it stretched like that, it's some cause for concern.
And Stuart, this is a rotation out of growth and into value.
Yes. This is the chart of my failure over the past few years. To be honest, Richard, I'm in the same way as one might dress in the fashion of one's youth. I'm investing in the fashion of my youth. I'm imprinted with a value philosophy, and I think here what we can really see is that growth has beaten value by just astronomical amounts over the past 10 years, and therefore the unwinding that we can expect has only just begun. I think so many measures show that yes, value stocks are cheaper than growth stocks, but they are very, very much cheaper than growth stocks. And the interesting thing when you look at research from people like GMO is that the growth prospects aren't that different between value and growth. Yes, they're weaker among value stocks, but not to the extent that would justify the premium that growth stocks are trading at. So I'm, fingers crossed, hoping, expecting that this is the beginning of a pretty protracted period of value stocks beating growth. And I'd also add to that non-US markets beating the US market.
Yeah. I would just also add that I think with value stocks, the value stocks are earning money. They have earnings. They probably pay dividends. That's why they're value stocks. So all value stocks in a basket of value stocks are earning money. All growth companies in a basket of growth stocks will not be successful. Some of them will be. So you are investing not only in businesses that have no earnings, but in businesses which are very vulnerable to ceasing to exist. And that isn't really taken into consideration in terms of calculating the risk of owning only growth stocks.
Yes, I think they call it the torpedo effect, don't they? Where the growth stocks, they're all valued as if they're all going to be successful.
Yeah.
And then obviously they can't all be successful. And so when the torpedo happens, there's no safety net there.
Okay, I didn't know that, Stuart. I shall remember that. When you get torpedoed, presumably. So we've probably all seen this graph recently. It's great. Warren Buffett is now beating Cathie Wood since the start of the pandemic. And
Yeah, and about 20% of the market cap of Berkshire Hathaway is cash. So, there's a fair bit of a safety net there.
Which is depreciating at a rate of around somewhere between 10 and 12% per annum at the moment.
Well, yes, there is that. Yeah.
So on to Bitcoin and cryptocurrencies. Well, it's been a ghastly 3 months for crypto. It's halved, roughly speaking. Some have more than halved. And I have sat on my hands personally. Whether that's been sensible or not, time will tell. But energy commodities. So it's been a great year to date for energy commodities, and a pretty good week apart from uranium. And the we discussed earlier, one of the problems with this is that the energy feeds directly through into inflationary pressure. So we can see that crude is almost unstoppable now from late November, where it's gone up nearly 30% since late November.
Richard, I remember your comment a couple of episodes ago about a windfall tax. Have you heard anything more about that?
I have heard it being mooted again, but I don't know whether I haven't heard anything definitive about it, Stuart. This is saying that China will be the main source of oil demand growth in 2022. And this chart is another chart that shows that oil and gas investment is insufficient, basically, to enable consumption to continue at current levels, and which is going to be another impetus for increasing prices. And I did see the other day Goldman Sachs forecasting oil 1 year out at $120 a barrel. I know a year ago they were forecasting at $80 a barrel, so they were right there.
I'm interested to see that it's not just oil, gas and LNG capex that's modest. It's also the midstream investment.
Yeah.
I have a little exposure to some of they used to be called master limited partnerships. They've now converted to corporations, and they take a toll basically on the oil and gas going through their pipelines and storage facilities, which are a lower risk way of getting exposure to this. And if they can maintain their capex discipline, then the free cash flow from those things is phenomenal. Because
they take a percentage toll as opposed to a unit price.
Yeah.
Interesting. Dutch natural gas futures. So that spike has come off. We know that there is a lot of liquefied natural gas now coming into Europe, which presumably has taken quite a lot of the heat off the demand problem, the supply-demand issue. And it's a chart that shows Russia Yamal to Europe gas link zero flow since December the 21st. But despite that, the gas price has remained reasonably steady in the last 4 or 5 weeks. And this one shows the European natural gas storage. Now, I think my interpretation of this chart is we're okay. So we're down here just below 500, January 23.
January the 23rd.
January 23rd. Oh, I'm with you. Right, yeah.
Yes.
But if you then go back to 2018, we were similar level. If you go back to 2015, we're at a similar level. I suspect what's happened is that there's been substitution by liquid natural gas to a great extent. That is pure speculation on my part, I hasten to add. And the price of coal is soaring again now for reasons I don't know. Do you have any insight here, Stuart?
No, not particularly. The thing about coal that interests me is what the attitude of corporate management is. If they are going to be, like tobacco and say, right, look, we're ex-growth, we need to actively shrink ourselves and pay out the cash, then as a purely financial decision, that would seem to be very attractive. But the trouble is sometimes shrinking industries, doggy paddling, trying to stay afloat and diversifying and throwing money at pointless projects. So I don't know about those companies suggested here as possible research ideas, but I think the key issue is management philosophy.
It's also a question of duration, isn't it? So if they can offer 10% dividend for 10 years, and after 10 years, basically they're out of business because no one wants any coal, you get your money back, less inflation. So you have to see there's a long-term value in it. A bit like investing in Nasdaq companies. So this is an interesting chart that shows the sources of power generation in Germany and the fact that lignite, which is dirty coal, brown coal, produces a lot of sulfur, and which presumably they remove from the chimneys, is the second largest source of energy after wind, and nuclear will be disappearing as they phase their last 3 nuclear power stations out this year.
It's extraordinary, isn't it? It's difficult to, I guess you see the political imperative to stick to what you said before, which is let's get rid of nuclear. But the consequence of that doesn't seem to sort of cut any ice. No,
it's hard to understand. Price of uranium.
Richard, to some extent, maybe a difficult thing to say, but it's one of the problems of democracy, isn't it? That politicians will promise something. I think, did Germany promise to close its plants after the Fukushima accident?
Yeah.
Then they get locked into that. But if you're China and you don't care about the population's short-term opinion, you can plan genuinely long-term. And I believe that they've got a fleet of reactors that they're building to a plan.
They have. I noticed, I read today that the UK government is putting £100 million into Sizewell C to try and get the funding for that restarted, because obviously we're desperate to have new nuclear power generation as our fleet of nuclear power stations grows older by the day, like all of us. This is a graph of nuclear investment, which is rising but slowly. So moving on to industrial commodities, year to date has been pretty strong, and weekly change has been good in parts. So we've had good results, good powerful moves from lithium, quite a powerful reversal by magnesium this year. I think that I guess there's also confusion about whether Omicron and China is going to cause a slowdown in industrial demand or not. What do you think there, Stuart?
Oh goodness, way beyond my my expertise. I am sort of worried that if housing was 30% of the Chinese economy, and if that's got to slow down, what that does for sort of fundamental for demand for steel, for concrete, for anything used in that sort of hard industry. I know obviously there's the longer term perspective on copper and the green energy transition. So I don't know how to trade off those two. But for me, I know that I don't know. I'm quite happy to buy a FTSE 100 tracker full of interest rate sensitive banks and resource companies, and hope that it floats up in line with those macro bets. But more detail, I know nothing.
That's a fair comment, Stuart. This is a commodity scanner chart, which suggests that The positive price momentum is gold, silver, precious metals, nickel, aluminium, and zinc. Because there's a deficit and demand, and a negative price momentum on coking coal. I'm not quite sure what timescale this is looking at, because obviously the price momentum on coal recently has been very positive. So aluminium, which looks like it's heading back up towards its high. Cobalt, copper, which is really just moving around in a range now. Graph of global outlook for primary copper demand and supply. So we've got a Rystad Energy saying there's a shortfall from mid-2023 onwards, which I think is coincident with other sources of this information that we've got. It's not a huge shortfall, has to be said, but it is nevertheless a shortfall. So, and iron ore is gently trending back upwards. And lithium is continuing to be driven by, I think, speculative demand based on its use in vehicle batteries. But clearly, it's got a lot of momentum behind it. And this is a chart showing that the supply and demand of lithium is going to go out of balance in around about 2026, although that's quite a long time ahead still.
Yes, I remember the IMF chart that I produced a couple of weeks ago. I think was it lithium was the mineral which was most forecast to be in deficit under a net zero scenario that the IMF were trying to estimate. So yeah.
I mean, the only problem with lithium investments is if someone comes up with a better alternative in terms of batteries for vehicles. There's no sign of one yet, but I guess that's the biggest risk. And that projected supply demand gap is causing forecasts of lithium prices to remain high. And this was a lithium mine that Rio Tinto wanted to open, and I think the permit was withdrawn due to effectively protests by local people who didn't want a lithium mine on their doorstep. It's okay if it was in China, presumably.
Yeah.
I mean, I think we need to be much more careful of our natural resources and looking after our worlds than we currently are, wherever it is. Magnesium, neodymium, which is continued to rise quite strongly. And nickel had a big pullback, but it had a very sharp rise, and remains to be seen. Tin, likewise with nickel, but that uptrend not broken. And ferrovanadium has spiked this week. So on to precious metals, which have generally, apart from palladium, have not had a good week. And palladium has had a very good week and year, and rhodium's had a good year. So Stuart, you wanted to talk a little bit about gold?
Yeah, a little bit, just prompted by a podcast that I listened to. It was a podcast from the BBC, there in our time programme, about the gold standard. And I initially sort of poo-pooed and thought, oh, yeah, I know about the gold standard. Yeah, currencies used to be convertible to gold, etc. But I realised that my knowledge was actually rather superficial, and that I assumed that the gold standard had been in place, more or less, for hundreds of years prior to the 20th century. But that really wasn't true. That the gold standard is really from about 1870 onwards. That pre-First World War period, 1870 to 1914. Yes, currencies had been convertible into gold prior to 1870, of course, but as part of a system, the classical gold standard is really only from about 1870 onwards. Mm-hmm. And it really facilitates a massive sort of wave of globalization as other countries join the system, in particular the French joining the British. And I also assumed that gold discoveries would mess everything up because you'd be vastly increasing, in a sense, the money supply. So when you get the California gold rush or you get gold discoveries in Australia, I thought that would mess it all up. But the argument is actually that it made the monetary base large enough to support more countries joining the system. So it actually made it possible rather than messing it up. The other thing that I took from it is that a bit like you see with statements like when Mario Draghi was talking about we'll do whatever it takes, if you can make a credible commitment, then you never get tested on that commitment. And so the central banks linking their currencies in pre-First World War Europe had tremendous credibility. And so it developed its own momentum and stability. There was a second period of the gold standard after the First World War, which I think in traditional economic histories is seen as very wrong-headed. Central banks not reflecting the changed realities that inevitably had resulted from the First World War. And I think Churchill putting the pound back on the gold standard at the pre-war rate was seen as sort of folly and as a sort of sign of hubris. But at the time, this podcast is making the case that the central bankers were really trying to do their best, trying to return to stability, to help populations via or establishing financial security, or at least financial system security. But the need for central bank cooperation was still there, but became more and more difficult to maintain as the reality of different countries' economic positions, in particular the difficulties the French were having, ripped the system apart. Now, the reason I'm bringing this up is, partly it's an interesting podcast, but also because of the similarities between the gold standard and the euro. That the gold standard highlights what I think has commonly been referred to as the eternal trilemma, that there are three things you might want, but you can only have two of them. The first, you might well want a fixed currency because that's attractive for stability and investment predictability. You might want the free flow of capital to enable investment to come into your country, and to establish the fixed currency, you need to be able to facilitate exchange. But you also want independent macroeconomic policy to account for local conditions, so fiscal and monetary freedom. But you can only have two out of those three. And the interesting thing is the similarities between the gold standard and the euro, where you can see that one size is not fitting all. Germany, for instance, is benefiting from a currency fixed at probably a rate lower than a renewed Deutschmark would have. But it's suffering from inappropriately low interest rates, which you could argue is fueling a housing bubble even there. Conversely, Italy can't adjust its fiscal stance because it's locked into the euro mechanisms. So if you think about the tensions within the euro as being like a gold standard, I think I think Keith has brought this up a few times as the internal tensions are likely to rip it apart at some point.
Yeah.
So in the back of my mind, I can hear Keith saying, yes, this is why we don't trust the euro. This is why we're not invested in anything to do with the euro. But I've got a slightly different perspective on that. And that's sort of illustrated by the chart on this slide. The red line is the pound euro exchange rate, so about 120 at the moment. And the yellow line is the OECD's estimate of purchasing power parity. Now, PPPs have to be taken with a bit of a pinch of salt. Estimating them isn't easy, but when something is about 20% away from a PPP, that sort of perks up my interest. So I've been thinking about various sort of euro-denominated bets, but as I say, in the back of my mind, I can hear Keith saying, yep, but it's all going to end in tears because there are fundamental contradictions within the euro. Mm. So then what I'm thinking is, well, yeah, okay, if it's going to break up, you want to just make sure you're on the right side of that breakup. So you want to be looking for assets in what would be a residual strong euro area. So if you can buy the euro cheap and then be in the part which is most likely to appreciate, I mean, you could get a bit of a double whammy benefit there.
Interesting, such as German equities.
Yes, German property, German something or other, yeah.
So I came across this, has gold lost its mojo? Because clearly gold hasn't been performing as one would expect it to perform in this, what we consider to be inflationary environment. And this is a graph showing the US break-even inflation rate and the US CPI. So the break-even inflation rate is that which is derived from the interest rate on inflation-linked bonds. And clearly, it's not reflecting the increase in CPI. And the there's this interesting little, if you go to this website here, there's a PDF you can download, which is a discussion by Ronald Peter Sturfley about this issue and what gold might do in 2022. And it's quite interesting. But this is the sort of the nub of the problem for people who think gold is a protection against in inflationary times. It's, well, why isn't it? That's the nub of the puzzlement. And if you read this, it's quite useful. And this is a graph of the gold price adjusted for US money supply since 1934. And obviously, US is no longer on the gold standard, as we have just discussed. But it does show that it is pretty much, this is not my dirt cheap, I hasten to add, but it does say that it is pretty much at its lows in terms of value of gold, price of gold versus US money supply. So just moving on to the other precious metal charts, we've got silver and platinum and rhodium, none of which actually are doing anything very much in the great scheme of things. And finally, we move on to yields and rates, where we've had some significant increases over the last week. Not so much over the last year, but certainly over the last week. I think as the Fed has been intimating that it's going to tighten, I think there's an expectation that the Bank of England will have to do so as well, isn't there, Stuart?
Yes, I think so. That's it's the question is obviously how much and when, and I'm alert to this issue for rolling over my mortgage in the summer, and whether I can get to the summer and lock in a low rate before it's pushed up too high.
Too late, yeah. And then we've got the extraordinary low rates of the Greece, Italian and Spanish bonds. And we move on to the graphs. So I've done these over the longest period that I could. And you can see, to my mind, how absurd the Greek rate looks in comparison to where it was, let's say, in 2016 at 10% with the level of inflation that we have now.
Richard, it's almost like there's an internal contradiction in the euro area.
Indeed, yes. And we have the same for Italy. And so this is the UK 10-year gilt over the last 20 years. And you can just see the inexorable decline. And imagine what would happen if interest rates went back up to 7%, which would give a real yield of about 0.
Mm.
And the US 10-year, imagine what would happen if they went back up to 7.5% for the real yield of about 0. And so is the FTSE seasonality chart, although there is still time for a quick bounce. So Stuart, would you like to tell us a little bit about your portfolio in this volatile week?
Well, I think a little bit is about all that I can say, because I do tend to turn off the screens here. I haven't been doing very much. Year to date, I'm down just under 1%. Obviously, given how markets have been doing, that's no surprise to have lost a bit, and that's a normal sort of fluctuation. The only activity within my SIP, at least, has been to buy a bit more of a gold ETF, where I've got a sort of policy of gradually averaging in over time, because I know that I won't have the fortitude to pivot and to plunge and to buy or sell a lot. So I'm going to be very interested to pick up that PDF and that link that you mentioned, Richard, because I've been, along with many people, disappointed with what protection gold has offered. So I have been following my program and buying a little bit of gold regularly, but with some frustration, really. What I have been doing is buying some venture capital trusts. I think I mentioned this a few weeks ago. It's coming to the sort of VCT season as the end of the tax year approaches. The only caveat here is that, my goodness, they're selling like hot cakes. Some of the offers are being sold out in 3 or 4 days, which does rather indicate a bit of a panic out there, which is usually not a good time to be following the herd.
Yeah. Well, good. Thank you very much for that, Stuart. My portfolio has been an example of total inactivity. I'm down 1.2 for the week. My change for the year is up 1.6. FTSE all shares is up 0.2. No purchases, no sales, firmly sitting on my hands.
Masterly inactivity, Richard. Masterly inactivity.
Thank you very much. I am very exposed to commodities. So my only concern is the world economy doesn't slow down too much so that commodity prices fall. But my investments are for the long term, and I am really trying very hard to stick with that philosophy. So, well, on that note, I think we've come to an end of this podcast. Thank you very much, everybody, for listening. Please press like and subscribe, and of course, refer us to your friends and acquaintances if you think they'd be interested in watching. And it's goodbye from Stuart Owen.
And goodbye from Richard Wheater. Thank you.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.